Hi everyone, I hope you are ready for another tax study session. I'm going to be your virtual companion in studying the tests in determining whether income is earned for tax purposes, which is also part of the coverage of our exams. Before we start, here is our student's guide to learning from home. Set up your study space. Find an area in your house where you can sit comfortably and focus. Make it separate to your relaxation space, ideally away from a TV screen or other distractions. Take down notes. Stop in a webinar zoning out. Taking down notes keeps your mind engaged. Plan your day ahead. If you have one, follow the schedule provided by your school. If you just have a list of things to study, break it down into small tasks and plan to do the hardest ones when you have the most energy. Lesson distractions. Harness your imagination and picture that you're at school and not at home. Lock your phone away if you need to. Don't be afraid to ask your parents to intervene. Subscribe to productivity apps as well. These are great study companions so you can focus 100%. Change it up. You probably have a schedule for your lessons. But if things are becoming difficult to focus on, take a 5-minute break and come back to it. Just let your teacher know. Be kind to your mind if you need a break from a consistent schedule. Now, let us proceed with the topic for this video. What are the tests in determining whether income is earned? The first test is the realization test. Under the realization test, there is no taxable income unless income is deemed realized. Revenue is generally recognized when both conditions are met. First, the earning process is complete or virtually complete and an exchange has taken place. If you have seen our previous video, we discussed realization test also in the concept of income. Second test in determining whether income is earned is the claim of right doctrine. A taxable gain is conditioned upon the presence of a claim of right to the alleged gain and the absence of a definite unconditional obligation to return or pay. This is also called the doctrine of ownership, command, or control. In the claim of right doctrine, if a taxpayer receives money or other property and treats it as its own, under the claim of right that the payments are made absolutely and not contingently, such amounts are included in the taxpayer's income, even though the right to the income has not been perfected at that time. It does not matter that the taxpayer's title to the property is in dispute and that the property may later be recovered from the taxpayer. Under this doctrine, if the taxpayer who has included amounts in income pursuant to the claim of right doctrine subsequently repays those amounts, the taxpayer may be entitled to a deduction in the year of repayment. However, to be entitled to a deduction, the taxpayer must meet the requirements of a statutory provision entitling him or her to a deduction. For instance, it must qualify as a trade or business expense or as a loss. The last test in determining whether income is earned is the economic benefit test. Taking into consideration the pertinent provisions of law, income realized is taxable only to the extent that the taxpayer is economically benefited. The economic benefit doctrine reputed to have been born in dictum of the 1945 opinion of the United States Supreme Court in Commissioner v. Smith. In Smith, the taxpayer had received a compensatory option from his employer to purchase stock in another corporation at a fixed value. At the time of its exercise, the option price was lower than the fair market value of the stock. The commissioner argued that this difference represented compensation to the employee, includable in his gross income, in the year the option was executed. From this seed sprang a body of both regulatory and decisional law which developed the dictum of the Smith case into an axiom of tax law which ultimately became known as the economic benefit doctrine. In order for the modern doctrine to apply, an individual must unconditionally transfer money beyond the reach of the transferor's creditors and place that money in a fund in which the taxpayer to be benefited has vested rights. Thus, the doctrine focuses on situations where a cash-basis taxpayer, having a right to receive money, elects to defer the income that would arise from the receipt of the money by pre-arranging to have the money deposited in a third-party account. Armed with these concerns, the courts have developed the economic benefit doctrine, which requires the inclusion in income of such amounts in the taxable period in which the fund was created. This American case has persuasive effect in our jurisdiction because Philippine income tax law is patterned after its U.S. counterpart. Lastly, we have severance test, also known as the Macomber test, which states that there is no taxable income until there is a separation from capital of something of exchangeable value, thereby supplying the realization or transmutation which would result in the receipt of income. The essence of the test is that in order for income to be taxed, it is to be severed from the property from which it was derived. The court analogized capital as being separate from income in the way that a tree is separate from its fruit. It requires the presence of a tax event, which is an event which triggers a transfer of ownership of property. That would be all for this video, guys. Please do share and subscribe to my channel for more tax lessons. And this is your virtual mentor signing off. Remember, do not just wait to be an inspiration. Be the inspiration. Keep safe, everyone. Bye.